Hello, take a look at these two graphics. This first one is very colourful but also very busy indeed. We will explain that for you in a few moments, along with this graphic showing two rising bar charts. Further details in just a few moments as we speak with Vivian Heng, who's a senior investment advisor at Standard Chartered. I guess you're here, Vivian, to help us understand the most important steps to get started in investing. What are they?
First of all, is to assess your risk appetite. And then, second of all, it's to diversify your investment. Third is to determine your timing in the market, your time in the market. Fourth is to use averaging to your advantage. Fifth is to start investing early and reinvest your gains. And last of all, the sixth point is to regularly review and rebalance your portfolio. These are the key, what we sum up as the key principles of investing within Standard Chartered.
All right, let me take you up on that first point about risk appetite. Is it as simple as saying, I want to invest in things where I can sleep easy at night? Is it that simple?
Well, yes, in a way it's true to a certain point, because not all investments are for everyone. So it's important that you assess your risk appetite and know what you're in for, because everybody wants to go for the highest gain in the market, but not everybody is able to stomach that kind of gyration and fluctuations within their portfolio. Some people, they prefer a calmer ride throughout market volatility. So it's best that you seek out, try to do some profiling on your risk appetite before you actually, narrow down on your investment options and your investment strategies.
And is it easy to do that? Because I can imagine that some people say that they are risk averse, but actually they then take very risky bets in the market, or the other way around, where they say that they're very happy to take on risk, but deep down actually they'd much prefer to stay in safer investments.
Well, I think it's important that they continue to recognize that by taking on higher risk, it doesn't always translate into higher returns. But in order to achieve higher levels of returns, then it's probably necessary that you accept higher level of risk for that to happen.
And you've got that on this next chart here, where you've outlined quite a number of asset classes. They seem to be going up in a diagonal fashion from bottom left to top right. So can you talk us through, firstly, what are we seeing in the bottom left corner here? Bottom
left corner, we see cash. And if you actually move, in a diagonal fashion in this manner, where you move higher to the top right quadrant of the map, risk return map, you can see that equity investments, which are inherently more volatile, they can also fetch you higher expected returns as well. But if you were to be an investor who has more moderate risk appetite, then it's perhaps more suitable that you go for something somewhere in the middle, which we have over here: emerging market bonds and also global bonds, as well as some hedge funds as well.
Right. And now to the graphic which I showed earlier on, and this is that very busy one with lots of different colours and text. Without wanting to read every single word on this very busy graphic, what is it trying to show us?
Okay. In summary, what this is actually saying, it's what this does is it arranges the individual asset classes' performance from the best to the worst, starting from the top to the bottom, for years 2000 to 2009. And what this actually says is that there is no one asset class that will consistently top the chart year on year. So it's really difficult to time the market and to pick out a winner at all times if you're just betting on one asset class. So it's important that we look at diversifying our investment and not timing the market as well.
In other words, there's no clear winner year after year.
Yes, that's correct.
That actually makes it even harder to invest than makes it easier, right?
Well, it's not harder. Well, and of course, investment is not, it's not a walk in the park as well. But we think that if you actually were to be able to put together a portfolio where you put together investments that correlate lowly with each other. Let's say if you are somebody with a moderate risk appetite, then when the market moves against you, the downside risk in your portfolio can be limited if you have investments that correlate lowly with the riskier investments in your portfolio. So what it means is that you shouldn't be putting your money in just one asset classes and holding them out throughout the different market cycles. So it's best that you actually put together, for example, if you have a basket of just stocks in your portfolio, it's perhaps best to also add bonds into that portfolio so that you bring down the volatility of the portfolio, not sacrificing too much returns, and you actually can improve the risk-adjusted returns of your portfolio as well.
All right, and let's say you've done that asset allocation. Do you then throw all of your money at it in one go, or should you invest bit by bit, perhaps every month?
Yeah, well, this is always a question that clients ask, is this the best time to invest, or do we, wait out until things come off further? We think that there is really nobody can really time the market accurately all the time. So it's best to perhaps do your investment via what we call a dollar cost averaging method. And in this method, what you do is you put aside, you actually put in a fixed amount of money over a regular period of time, and then you basically just invest in a very disciplined way, where you pick up more units when market is down, and you actually pick up less units when market is actually up.
When things are cheap, that's when you're buying more. And I guess that's what this graphic here is trying to say. Let's just look at the last line of each graphic. The table at the top says that you've bought a total of about 10,000 units. The one at the bottom says 10,280. Why is there that difference?
Okay, for investor number one, you put in one whole lump sum, and you realize that at the end of the 4th month, you still have 10,000 units based on the 1 unit price that you buy at. But whereas for investor number two, you basically divide your investment into 4 different months, and basically to do dollar cost averaging. And you realize that in this example of investor number two, he actually picked up more units when the prices went down, and less unit when the price went up. So all in all, at the end of the 4th month, assuming if the stock price actually stays the same at, let's say, at $2, his average cost of each unit is actually $1.94. But if the cost of the unit price is at $2, which is higher than his average cost, then he basically have a higher investment gain, than investor number one, even though he didn't need to time the market. And also at the same time, you basically spread out your risk by putting in small amount at a regular interval, than to come up with one whole lump sum at the start. So this is actually good for clients or for investors who want to start small.
Right. And I guess it helps you to avoid having those emotional pangs of, do I buy now, just as everything seems to go haywire in Europe, or do I wait till later? The emotion is taken out. But I've also heard people say that it's more important about the time in the market than timing the market.
Well, it's very important to for this particular issue, we think that it's important that clients recognize that if they have, say, a financial goal that they need to reach in 1 year's time, say if they want to buy a house, then they have to recognize that in this short period of time, they probably need to preserve their capital in a certain way, and therefore it's not advisable to take risky investment, because you never know where the market's going to turn 1 year later. So, but then again, at the same time, if you have, say, a retirement goal in mind, which is 20 years down the road, you're more able to ride out the volatility of the market, and therefore, for such kind of investor, it's perhaps more suitable for them to take on slightly riskier investment, depending also on their risk appetite.
Right.
When we talk about time in the market, based on our research, we found out that for clients who actually stay invested in the market, regardless of market cycles, they tend to be also to be able to participate in the market's best trading days and best performing cycles as well. Because it's really tough for somebody to be able to accurately pinpoint, when to buy low and when to sell high. So if you actually stay invested in the market, you would be able to catch the best trading days. And we found out that clients who actually do that, they tend to have returns that are 30% better than somebody who tries to time the market, and miss out, say, the 5 or 10 trading 10 trading days in a cycle.
And I guess that's borne out on this second chart that we also pulled up at the beginning of our conversation. What does this chart show us?
This chart shows you the power of compounding, which Einstein says is the most powerful force in the whole universe. Okay, so what this actually means is that if you were to, even if you were to start small, and if you were to start early, and if you reinvest your gains back into the market over a long period of time, you will be able to achieve or potentially maximize your returns and do better than somebody who even start later. In this example, we're talking about 2 persons, John and Paul. And John, what happens is he starts at the age of 20.
All right, so that's the little bars at the left side of this graphic.
That's right. And he invests for a period of only 8 years. Okay, and Paul, he started 10 years later at the age of 30, and he invests for a period of 20 years. And we can see that based on the representation on this particular chart here, it's because John started earlier, and because of the power of compounding, he was able to outperform Paul even over the long term, even without investing, for a longer duration than Paul.
Isn't that amazing?
Yeah.
So just by starting earlier, even though he invested less for shorter, he comes out ahead.
Mm-hmm. Yeah.
All other things being equal, I guess.
That's right. Assuming that the returns are the same year on year for both person.
All right. It's great to have you with us. Thank you so much for coming in.
Thank you, Mark.
Vivian Heng from Standard Chartered. Singapore Investment Week, August 25th to 31st. Here is the URL, the website that you can go for further information. Thanks so much for watching.